Okay, so I'll move straight to the next slide, calculating intrinsic value for GCB. We've been analyzing GCB since we started this classes. All right, so we're going to use the FCFE and the DCF approach. FCFE is estimating the free cash flow of the business. All right, and the DCF is basically what the company is worth today based on how much money it's expected to make in the future. What the company is worth today based on how much it's expected to make in the future. Free cash flow, FCFE, is the free cash, the cash component of what the company, of what is available to the company. So the core challenge, we are assessing GCB's intrinsic value using the free cash flow to equity. Free cash flow that is entitled to shareholders. Equity is shareholders. Equity is shareholders. So free cash flow that is entitled to shareholders. Then we zoom into the discounted cash flow model. So the free cash flow that is entitled to shareholders, we forecast it into the future. All right. We forecast it into the future and we discount it to today. And that is what is termed as the intrinsic value. Okay, so the value as at today, we divide it by the shares outstanding, the number of shares outstanding, and that will come up with the price. So this helps us determine the current market price, whether it is a good investment or not, whether to buy it at the current price of 9 cedis, whether it's good or not. Okay, so our goal is to uncover if GCB shares are currently undervalued, overvalued compared to their true worth. Okay, so I've explained the approach. We'll project the FCFE from 2026 to 2030, assuming, as you can see, I've written the assuming a 15% annual growth rate, assuming. Another analyst can decide to put 10%. Another can decide to put 5%. I decided to put 15%. So the assumption of this 15% may be too high. The question is, why am I assuming at 15%? I am assuming the figure at 15% because I realize that the past events or the past figures are too volatile. They are not consistent. They do not flow at a regular pattern. So therefore, if I'm using a certain rate, for example, when I did the average of the past from 2021 to 2025, I realized that the average was way above 30%. So the next value I can use is 30%. All right. I think that 30% is a bit on the high side. So I kind of be on the conservative side and put 15%. So based on your assumptions, that is where you can come up with your figure. You should be able to be explaining these things to any investor or any analyst who is contesting your figures. So based on these assumptions, I am able to forecast the free cash flow and then discount it into today's value using the cost of equity that I'll come up with. So the verdict after even with this valuation approach, all right, the calculation yields an intrinsic value of 64 cedis. Yesterday or previous ones, I have shown you different approaches that have yielded about 21.11 cedis. All right, this one says 64 cedis. Listen to the approach and let's understand. You can do your own analysis and come up with your estimated price. All right, it has to make sense, which is significantly higher than the current market price of 9 cedis 54. Okay, it suggests a potential bargain. In fact, all the approaches that we have used, you realize that every single one of them points to the fact that the current price of GCB is trading way below the intrinsic value. All right, way below all the approaches that we have used so far. Now, let's move to the next slide, which is the free cash flow to equity. So the formula, as I have mentioned, or as we have seen always, is net income. The net income for the respective years you're analyzing. You add the non-cash charges, normally depreciation and amortization. Then you take out CapEx, capital expenditure, so purchase of plants and equipment. Then the working capital. Working capital, there are two approaches that we'll look at. We'll look at two approaches. We'll look at the balance sheet approach and we'll look at the cash flow statement approach. All right, from both of them, you can derive a working capital figure from it. So based on the approach that the analyst uses, the values will come out differently. Okay, then we have the net borrowing, okay, which is the net of the borrowing and the deposits of the bank. All right, so in going through the figures as you have, okay, I'm expecting that as we are going through, you'll be looking through the data of GCB as I sent to you. All right, so in 2021, the net income was 227 million. We have it in the data. I don't want to be switching back and forth. So it is, the figure is 227807. Then let's look at the formula there, the formula. And as we are mentioning the figures, those are the respective figures. So the non-cash charges, 2021 comes up to 73184. CapEx comes to 32450. Change in working capital comes to minus 289713. That is for 2021. And the net borrowing comes to 391643. Okay. When you put these figures into Excel or into your calculator, this is what you get, 116611. So the free cash flow for year one, that is 2021, is 116611. Somebody can try it. If I'm wrong, you should let me know so that we can revise. All right. So it's the same approach going through 2022, 2023, 2024, and 2025. Okay. So over the past 5 years, GCB has demonstrated varying FCFE levels. So we identify 2116947 as our base year for 2025. So that is the free cash flow here, 211947. That is in 2025. The last figure at the bottom right, we identify it out as our base year FCFE for 2025. So based on these figures, or based on this, we're going to start making our projections, our forecasting. Okay, so which will be the starting point for our future projections. So this comes to the end of the free cash flow for the past period. Free cash flow for the past period, 2021 to 2025. It's net income plus non-cash charges. You take out CapEx, you take out change in working capital, then you add back net borrowing. We'll go into the sheets, the data, the GCB financials data, then we'll look at all these components. Okay, if you are still not clear. All right, but I'm expecting that you will have your sheet opened, displayed in front of you, you watching the figures as I'm mentioning them. Okay, so the next slide. Now we move into the DCF analysis. All right, this formula, it looks some way. All right, for us in the field, you don't have to worry about sticking this thing in your head. All right, but it's quite basic. So the FCFE with the time. Okay, so bringing the FCF into the present value and throwing them into infinity. Let me break it down. So this formula aggregates the present value of all future cash flows to equity and the present value of the terminal value, then divides the total number of shares to arrive at the intrinsic value per share. Now, first, let's pick our cost of equity. Cost of equity is very important in these calculations. Cost of equity, because we are dealing with stocks, we are looking at what investors are expecting to get. Then the last presentation, I explained that this figure, the cost of equity figure, is the expectation of investors. All right. So if the cost of equity is 23, the investors are expecting to get 23 or more. At least if you're not getting anything, it should be 23. Calculated using the capital asset pricing model, the CAPM. So it's risk-free rate. We pointed out 10%. You add beta. Then you take into consideration the equity risk premium. If you check our past video about the cost of equity, I have gone detailed with the explanation of cost of equity. So please, if you don't understand the cost of equity, go back into our previous presentation and try to get an understanding before you proceed. I see somebody's hand up. Please, can you table down your question so that after the presentation you ask? Please don't forget, just write it down so that when I am done, you can ask all the questions. Thank you very much. Now we come to perpetual growth rate. So this steady growth rate for cash flows beyond the explicit forecast period. So in this presentation, we are going to forecast into 2030. So what about 2030 and beyond? That is when the perpetual growth rate comes into being. All right, and that one we peg it to the GDP growth rate. And you can get it from the Bank of Ghana, you can get it from the Ministry of Finance. So it's a steady growth rate for cash flows beyond the explicit forecast period. And the forecast horizon is 5 years, 2026 to 2030. Outstanding shares is what is displayed in AFX QUA. You see, Ghana Stock Exchange website. When you go to Yahoo Finance too, the figures are there. Okay. All right, so let me proceed. Now, 5 key steps to the intrinsic value. 1, you forecast. As I said, you forecast. So we project GCB's free cash flow to equity to the next 5 years, assuming a consistent growth rate of 15%. 15%. I've explained why I decided to use 15%. Another analyst can decide to use 10%, 5%, but I thought I should use 15%. Okay, so in 2026, this is the formula for the free cash flow for the years going forward. In Excel, what you do is you pick this figure and you apply this formula to it. So this 2434489 will be the FCFE in time 1. In time 1. Then you multiply it by 1 plus 0.15. When you do that, you get the next year's figure. So if you apply it to 2434489, now you get 2799662. Then when you apply it to 2799662, you get 3219. So that is the formula for the forecasting. You apply it through to 2030. And these projected FCFE figures form the foundation of our valuation, representing the cash expected to be available to shareholders in each future year. So all that we are saying is that in 2026, this is the free cash flow that will be available to shareholders. In 2027, this will be 8. 2028, 3.2. 2029, 3.7. 2030, 4.2. So all through these years, this will be the case of free cash flow. Now, the next step is to discount each of the free cash flow. Okay, you discount all of them, bringing future cash flow to the present. Okay, with this kind of analysis, you need to have in mind the formula for future value and the formula for present value, because that's all that we are using. This is the future value formula, and this is the present value formula. Okay, future value is the figure you want to project into the future. Okay, times the rate that you are projecting, 1 plus the rate. So you can decide to put 15% plus or 1 plus 15%. Okay, but for consistency, let's all go by the non-percentage approach. That's 1 plus 0.15. And this is the present value formula. Now we take each forecasted FCFE and discount it back to its present value using the cost of equity as our discount rate, cost of equity as our discount rate. This accounts for the time value of money, as a cedi today is worth more than a cedi tomorrow. I hope you all agree with me. A cedi today is worth more than a cedi tomorrow. Okay, so when you pick the free cash flow, the forecasted figures, 24, you realize it's a continuous thing, so kindly follow. 2026 is 2434,489. That's the same thing we have here. And 2030 is 4257. That's the same thing we have here. So these figures are the forecasted figures. Now bring these figures into present value. This is where you apply these figures. So FCFE 2434,489 divided by this into bracket 1 plus 0.2308. Then the time, exponent the time. All right, when you apply the figure, you come by this result, 1.98. You apply the same figures, the same formula on all of them. This time, the exponent, I'll do it in Excel for you to see. This time, the exponent will be 2. The next one exponent will be 3. So it means in 2030, the present value of the 4.2, 2025 value for 4.2 is 1.4. 2025 value of a 2030 figure that we have projected is 1.4. Okay, now we have to total the present value of the forecasted FE. So the sum represents the value of all cash flows GCB is expected to generate for its equity holders over the next 5 years. So all these present value figures, when you add them, you are getting 8536990. Somebody can compute that quickly. If it is wrong, kindly let me know. So the total of the present value of the forecasted figures, add all of them. It's a step-by-step thing. You need to follow the steps. I need to follow the steps. I think I missed step 3 is coming 2 times. Okay, so step 3 continue. Okay, so step 1, you find a free cash flow for each period. Step 2, you delve into the DCF analysis. These are the core parameters. All right. Step 3, you do the forecasting of every period. Continue. You find the present value and you total everything at the present value. All right. Now, step 3, another continuation. Calculate the terminal value. Just follow the steps. I'm going to share the slides with you. You can even build your own Excel with this, but mine, I won't give it to you. Build your own Excel with the steps. You can verify from anywhere. If the steps, you're not comfortable with it, you can verify from anywhere and apply the steps. But I can assure you that the definition for DCF or discounted cash flow or the approach for the FCF It's still the same. So the definition for DCF, it tells you what a company is worth today based on how much money it is expected to make in the future. So it is the estimated projections that we are bringing back to today. And that is the approach I am taking you through one by one. Now, the next step is to calculate the terminal value. Valuing GCB beyond the forecast horizon. Valuing it beyond the forecast horizon. And if you are new, the 23.08 here is also an estimated cost of equity. Is an estimated cost of equity. When we did the proper calculation with the figures, okay, it was around 37%. It was around 37%. But I said again, that for GCB, that cost of equity is too high. And looking at the size of the business, the size of the company, the productive nature of GCB, I thought that cost of equity was too high, because the cost of equity, it takes into consideration the risk part. That is the beta, and the beta, a lot goes into the beta. A high or a low beta can't either throw the cost of equity on the high side or bring it on the low. So I decided to put it at 23.08, and that is what we are using to do all our projections. So the terminal value captures the value of all cash flows beyond the explicit 5-year forecast period. So now this terminal value is going to do from 2031 to forever. It assumes the company will continue to generate cash flows at a stable perpetual growth. It assumes. Now, you see, let's pay attention to these words. It assumes the company will continue to generate cash flows at a stable perpetual growth rate. Assumes. So, assumptions. Now, this is the formula. Don't worry. As I said, so the FCFE of 2030, you apply the terminal growth rate, that is 4%. So that's what you can see. You see the future growth, as you can see, FCFE. So you're going to be your future cash flow figure times the perpetual growth rate, 4%. All right. K is the cost of equity, then then G again is the growth rate. All right. So back to the calculation. The FCFE as at 2030 was 4257937. Let's verify. The how do you call it? The FCFE as at 2030. So that's the figure we have here. 4257937. That's it. 4257537. All right, times 1.04, as you saw here, the cost of equity minus the growth rate. This is the formula for it. Wherever you go, there's a formula for it. Okay, so you have to have an idea of how the formula is. Now we come back and say this is the terminal value. So that means that all GCB's cash flow from 2021 onwards, going at 4% annually, is equivalent to this 23,198,997. 23,198,197 in value at the end of our forecast period. So 2030 beyond, this is going to be the value. All right, this single figure is a significant component of the intrinsic value, as mature companies often derive a large portion of their value from cash flow in perpetuity. So this figure is very important. Then you discount this figure again to present value. You discount it again to present value. After you've done this forecasting again into perpetuity, you bring it back to present value. Okay, so just as with the FCFEs, this figure 23,198,197, you bring it back to present value using the cost of equity figure. Okay, as you can see, so when you do that, it comes to 8,418,933. 8,418,933. Future value expected cash flow at future date, discount factor, calculate factor for present value of future cash today. These are just small few definitions. Discount rate, interest or required rate per period. Right. So the present value of the terminal value is 8.4. Now we are going to the final stages. Okay, if you follow how I'm going about it, it looks very simple. It is the assumptions that makes the difference. It looks very simple. So this stage, all right, the total present value and the interest per share. This is the stage where you derive your figures. So now, total present value of forecasted FCFE, the figure was 8536990. Present value of the FCFE, as you saw in the previous slide. Then the present value of the terminal value came up to 8418933. The next step is to put these two together, these two present value figures together. The present value of all the future cash flows plus the present value of the perpetuity. You put the two together, you get 16,955,924. This is the figure you can see. Total present value. Okay, total present value of equity. Okay, so once you put this, so this represents total value of all future cash flows expected to be generated by GCB for its equity holders, expressed in today's terms. So this is the intrinsic value. However, we want to know intrinsic value per share. So with that, you have to divide it by the number of outstanding shares. By dividing the total present value of equity by 26500 shares outstanding, we arrive at our final estimated intrinsic value, which is 64 cedis. This shows that this is the intrinsic value per share. So our valuation, 64 cedis per share, compared to the 9 cedi 54 suggests GCB is significantly undervalued according to this FCFE-DCF model. So you see the conclusion, read it carefully. Compared to the current price of 9 cedi 54, this suggests sometimes when you're going through this valuation, it's very funny. This suggests that GCB is significantly undervalued, and we have it according to this FCFE-DCF model. Okay, so you guys, you have to be bold. You have to be bold with your analysis. You have to understand the process. Okay, the process for this model is that we are concentrating on free cash flow over the past period. With this free cash flow over the past period, you forecast it into the future. So if you are doing a 3-year analysis, you forecast it maybe 3 years. That will be it will make sense to do it that way. 3 years, 3 years. So it's 5 years, 5 years. All right. After doing those estimations for your free cash flow, then you forecast it. You forecast it into the future. All the forecasts, you bring them into present value. Okay. With the next step, you forecast again into perpetuity. You bring the perpetuity into present value. You add the two, all the present values. So the perpetuity present value, you add it to the perpetuity, the present value of the future cash flows as you have calculated. Then you divide it by the number of issued shares. Then you get your intrinsic value per share. I think it's a bit straightforward. Understand the process, but the complexities here, there's some complexities here. How to identify that this is net income? How to identify that this is non-cash charges? How to identify that this is capex? And how to identify that this is change in capital? Then net borrowing. That is where I think the challenges are. Once you're able to identify these, then your cost of equity, that is also something that you have to be skilled about. Okay, because I got about 37% for the cost of equity, but I decided to bring it to 23. I should be able to explain why I decided to bring it to 23, right? And this is something that you guys should also try to work on as you do your evaluations day in, day out. Okay, so let me just go into the Excel and help you to identify these components. Then I'll open the floor for questions. 23.08. And so let me share the screen again. Okay, so this is the Excel. Okay, so realize that this Excel too, the value is as we saw in the presentation. So I'm going to go through the Excel for us to understand. Now, the net income. This net income, we get it from the income statement. Let me divide the screen. Okay, share this screen again. Okay, so I'm going to show you how to identify these components. Then, because I see that is where the issues are. That's where to how to identify where to pick these from. So the net income, where do you get the net income from? It's picked from the income statement. So as you can see from here, this is the income statement. So you come down to the net income. Or the net income. So this is it. This is 2021. The colored here is 2021. So 227807. As you can see, 30503. And the next one is 3. Like as you can see, it continues. Okay. Now, the non-cash charges. Where do you pick this one to from? It's from the cash flow statement. The ones that you can easily pinpoint. For those ones, you don't have any issue. There's no problem with them because it's just there. You just pick them as they are. So the non-cash charges, it's from we pick it. It's the depreciation and amortization, and we are picking it from the cash flow statement. All right. So you look for the depreciation and amortization from this cash flow statement. So from here, I'm going to do depreciation. Okay, so you can see it's the depreciation and amortization. Let me just color it so that you can easily see it. So 2021 is 73184. The next year is 73415, 65. So it continues like that up to year 5. Now the capex. Capex, we are going to pick it from that's a capital expenditure. We are going to pick it from this cash flow statement. Okay, so the capex, purchase of plant and equipment. Capex, let's see, purchase. Okay, so this is it. Now it's painted again. So as you can see, it's 32,450. The next one, 49,220. The next, it goes on and on. Now, this is where we start getting issues. From this side, I can assure you that all of you have started getting issues. So from this point, you see the change in working capital. Typically, the calculation is that it's the current assets minus the current liabilities. Current asset minus the current liabilities. Okay. However, with the change in working capital, you can also get it from the cash flow statement, where you take into consideration all of this. So change in non-pledged trading assets, change in loans and advances to customers, all the ones I've painted green here. Okay. What you have to consider when you are calculating the change in working capital. Basically, it is what is available to run the business, the cash available to run the business. Some may also take it this way. So deposits, when customers put in a lot of deposits, okay, it is these same deposits that the bank gives out some as loans. Okay, so it is what is left to run the business. That is what we call the working capital. What is left to run the business? That's why the key definition is the current assets, not the current assets minus the current asset minus current liabilities. Yes, that is why the definition is like that. Some analysts can decide to go minimal and choose just the loans and advances to customers vis-a-vis the deposits. Okay, so I can go very minimal and choose these two. Based on whichever decision I make, I put the change in working capital for my analysis. And you should be able to defend whichever position you take. Whichever position you take. So to be on the safer side, when you choose the balance sheet approach, so current liabilities, this is the yellow ones are the current liabilities. All right, and these are the current assets. What you realize is that the whole of the change in working capital will come out as negatives. Everything will come out as negatives, and you have to be smart to identify how you're going to go about this. So let me assume that change in working capital for year one is, let's say, minus 1 million. Let's say 100,000. Then this is minus 200, minus 300. Let's see what it brings the intrinsic value to. So it brings the intrinsic value to a higher value of 95.97. Basically, when customers bring their deposits, it is not all of them or all of the funds that is given out as loans. There is still a portion. And for banks, typically, that is how they run the bank. You cannot give everything that you are received as deposits as loans. So by all means, there has to be some amount that will be available to run the business. So if your liabilities, okay, so let me just go straight into it. Your liabilities are more than your assets, it comes into negative. Not typically it's negative. All right, it is negative. However, it is positive in the sense that there is more deposits available to run the bank. There is more deposits. Deposits is always termed a liability for the bank because they have to pay back at a point in time. So typically they are all negative. So putting the change in capital in a negative for all of them, realize that the price shoots up. It increases the intrinsic value. It makes it more valuable. Write your questions down. We'll answer them as we move on. Let me bring my values to default. Okay, let's to default. 64. Okay. All right. So we'll move to the next item, which is the net borrowing. The next borrowing is the new debt minus repayment. And that one is picked from the cash flow statement. Debt minus. For this particular one, we are looking at Let me pick the cash flow statement. It changes in the borrowings, changing the borrowings. So those are the figures that we put there. So as you can see, it's 391,643. So for this, it's quite straightforward. You pick this figure and you place it in your net borrowing side, and then it continues 196085737. They continue as you can see. Now, as you've gotten all this, the inputs are the most important. As I keep saying, the inputs are very important. Let me enlarge the screen now. Oh, were you seeing the screen? Before, were you seeing the screen as I was working through? Hope I didn't.
Yes. Yes.
Okay. So you can now see the entire full screen of the sheets, right?
Yes.
Okay. Now, so moving on, as I explained to you, now we have to come out with a free cash flow for each period. Now, all your inputs are there for you. All your inputs, net income, non-cash charges, capex, change in working capital, and net borrowing. They are all being inputted for you. Now you have to find the free cash flow for each period. That is what I said. You make sure. Hello? So with this, you have to go by the formula, as I said. So add, minus, add. Okay, when you do that, we come out with these values. So if you can remember in the slides, we mentioned that the base free cash flow figure was this 2116947. These are the free cash flows for each year. These are the free cash flows for each year. Okay, so with the free cash flows, what next do you have to do? You need to forecast them. You need to forecast. You need to forecast. I don't know whether this Excel, I did a forecasting. Let's see. So this is the first forecast. This is the second forecast. The test forecasts. Let me see. I think I did not continue with the forecasting here. Okay, so these are the forecast fields. Sorry. Yeah, these are the forecasts. So 2116 is the base figure. All right, then you forecast through the rest of the years. Now, as you can see, the formula there, it is G24. G24 is the base amount, as you can see. Then you forecast at 15%. It's the same you do for the rest of them. As you move on, then you add. This is the summation of all the free cash flows, the summation of all the free cash flows. Then I mentioned that you bring them, all the free cash flows, into present value. And this is it, into present value. Okay, when you bring them to present value, so you're going to come by this figure, 8.6 million. Now, we move to the terminal value. That is the perpetuity value. Okay, so with that one, D33 is what is the free cash flow, the forecasted free cash flow. B13, look for B13. B13 is the perpetual growth. Okay, B12 is the cost of equity. And you put those figures into the formula, as you can see, it comes to the 23 million. Then you bring it to the present value, that is the free cash flow, the future. You put them into the present value, divided by the number of shares. You come to the 64 cedis, as you can see. And the same as we got in the slides earlier. Okay, 64 cedis, as you can see here in the slide. So all this side is a summary of everything. 63.74. If you bring them, I will call it. If you bring it to present, you put your, you remove the decimals, it is 64. Okay, so average FCF is 68.608721. So basically, this is it. I want to give some of you assignment there. I know some of you won't do. With this, I'm going to share the slides with you. I want you to come up with your own Excel. Okay, come up with your own Excel. Come up with your own Excel. of this calculation. Come on, be on Excel. This is it. This is how it's supposed to be. The steps. You just have to follow the steps. Okay, so at the beginning of the presentation, I made the point that there are various ways to go about it. Another analyst can decide to use so the past figures, the past free cash flow figures. Another analyst can decide to do a present value using today's cost of equity for all these free cash flows. Do the present value for all of them, even though they are in the past, because the thinking is that the past is going to repeat itself. Okay, and that is the approach I showed you earlier on. That brought the value to 21.11. So with this, you would not see any forecasting of the cash flows. So it is this same free cash flow that we find the present values for. So as you can see, these are the present values for all these free cash flows. It is expected that these free cash flows are going to repeat. So we are bringing these free cash flows into 2025, even though they are in the past. We are bringing them to 2025. When you continue with the processes or the steps, this is the value you come out with. In fact, you see, I made mention that all the steps that we are going through, all of them point to the fact that GCB is hugely undervalued. So if you're even going by this approach, you realize that intrinsic value at 21 cedis is still a huge price that we can point to. And another position too is that with all the ratios that we have looked at, all the ratios that we have analyzed, all the ratios that we can see, ROE, book value per share from here, from 2021, even 2025, it is 18 cedis 54. This is a huge discount that we are talking about versus the share price on the market. If the book value is 18 cedis 54, it tells you that the stock is hugely trading at a discount. 2024, 12 cedis 17 pesos, 8.23 and so on. Return on equity, as you can see, the return on equity is huge. Okay, currently at 17.16. Optimal has to be between 10 and 15%. If it's going 17, it's a huge rate that you are looking at. Return on assets too is 1.86. Maximum or the optimal at 2, and it's doing 1.86. So it shows that this indicator too is very huge. PB ratio trading or at 0.51, also showing that it's not even 1, and it shows that it is trading under its fair value. So all the indicators here, all the indicators that we can look at, they are pointing to the fact that GCB is a buy stock. The only thing that is worrying the price discovery of that stock is that there is no match on the market. It is not liquid. When investors are looking for GCB, they don't get to buy. The ones that have GCB are holding on to them. They see it as a very huge treasure. They don't want to release them. That is why we are seeing that the price doesn't move, doesn't reach the extent to which it's supposed to be. It's now just around, I think, close to 9 cedis 57 thereabout. It's now, yes, it hasn't reached 10 cedis yet. And this is a worry, is a risk that you have to point out to investors that there's a liquidity challenge we have on the stock market. It's a liquidity risk. So there's no availability of stocks are not really very high. So it makes a price discovery. It may not attain the price discovery as we are all projecting. All right, so I'll end today's presentation here. I'll take questions. If you have questions, you can ask. Okay, I'll open the queue. Imanoni, please ask your question. Says Imanoni. Due to class, I've not been able to join the platform more regularly, so I was thinking if maybe there was a video lesson recordings where I can. Okay, so Emmanuel, if you're on the platform, the WhatsApp group, it's on YouTube. You can contact Emmanuel and he will help you with the link. Emmanuel, kindly put the link on the WhatsApp page so that everybody can have access to it.
Okay, please.
Any more questions, please? Any more questions? Okay, it looks like it's gone down well. I thank God. Bifa, any questions?
No.
No question.
Yes.
All right, Jacoby,
Hello, sir.
any questions?
No, sir.
Okay. Oh, then that it means that the thing has gone down well. It has gone down well. So the only thing that you have to do is to just follow the steps. I'm going to share the slides. Okay, I'm going to give it to Emmanuel. He's going to share it with you. Just follow the steps. You know apply the formulas correctly. Apply the formulas correctly, and then you come out with the figures as you are looking for. Okay. So I want to end here. We'll continue.
Please, I have a question.
Okay, so introduce yourself and ask, please.
Okay, my name is Dennis. So the
Dennis,
price
please
per stock calculated for GCB for the next 5 years was 64 cedis. But I want to know how the price will be moving with time. Maybe the first year, the second year, and the third year.
Okay. All right, we'll get there. It's let me just show you. We'll get there, but if you are in a rush, it's in the my system is frozen. It's in the Young Investor Calculator. If you're in a rush to know, let me just show you why this target price. So that's where you see the target price. Okay, so with the target price, you put the current earnings per share. Okay, let me pick the right figures for GCB. What is the current earnings per share? What's the earnings per share? Earnings per share. The earnings per share. So the current earnings per share is 3.18. Okay, this one. 3.18. Expected earnings per share, I think I pegged it at 15%. Current PE ratio, go back to Excel and pick the PE ratio. PE ratio, so 3. Current PE ratio is 3. And calculate. All right, these are the expectations. These are the expectations based on these figures. Based on these figures, let's see if this is 20, it goes up. So as I said, the 15% is my conservative approach. If you put it lower, you get lower. But this is an estimation. As I keep saying, you can see they boldly stated the estimated target price, estimated. And I've made mention of the fact that the liquidity risk is there. So if they are trading very regularly, these prices will be discovered in no time. So the stock is estimated to reach 11 in 1 year. It's possible. 13 in 2 years, assuming EPS goes 20% and the PE remains constant. So these are assuming. So you can see assuming EPS goes at this and the PE remains constant. Yeah. So this is how to go about it. In case we do not go deep into it, this is the formula. You can pick it. This is it. You can pick it and start practicing it. Any more questions, please? Okay. So thank you very much. I think we've done quite a lot today. We'll meet tomorrow. I'll go over this again tomorrow. And tomorrow is Friday. Tomorrow is Friday. So I'll go over this same topic again. I'll come from the DCF, the cost of equity, and come to the free cash flow to equity, then to the DCF. They will end there. All right. Saturday, we'll do a recap of everything. Ratio analysis. Okay, so we'll do trend, ratio, the free cash flow to equity, the DCF. So we'll touch on these 4 key areas. Make it a date to meet with me tomorrow. Thank you very much for your time. Bye-bye. And if you don't understand anything, you can send me a message so that we discuss it back door.